research associate, not coming directly from academia, but more from the private sector. So there's quite a wealth of knowledge in the public sector and the private sector, where he was head of innovation research at Danske Bank. They decided in 2015 to start his own company, advisory. We decided to start his own advisory, markets and money advisory. So he does consulting work around the world, US, Europe, where else, Saudi Arabia,
Africa.
So he has a particularly interesting outside view of Africa, where he spent a lot of his time looking at the central banks here. So just wanted to tap into that knowledge, and I think today and throughout the week, especially tomorrow's students who are maybe I think you're going to enjoy the lecture tomorrow and today. And the topic today will be on why global yields are so low.
Thank you. Yeah. Reason I have the microphone on is we are recording this, so you can go home and watch it once more, or at least see the slides and my voice. But thank you for the welcome. It's great to see a lot of people in the room. I will first of all try to provoke you a little bit, and I will try to maybe be slightly revisionist in terms of recent monetary history, or at least try to get you to think about what have happened in the global economy over the past decade, since the crisis of 2008 hit the global economy, particularly in Europe and the US, and get to think about monetary policy in that respect. And my argument would be there is nothing special about what we've seen. It all fits into our textbooks, and I will be deliberately simple in saying, okay, if you take the textbook on monetary theory, can we explain what happened? Can we do it with a few equations? Can we get a framework in which to think about what have happened? And one of the things, of course, we learn, which is wrong, is that when we take up any newspaper, open the Financial Times, you would see monetary policy in Europe has been ultra accommodative since 2008. Or the Wall Street Journal, the Federal Reserve's monetary policy is extremely easy. And the reason this is said is twofold. One, interest rates are historically extremely low. That's a fact. The other thing is, well, the central banks have increased the money base dramatically everywhere. They're printing money. I should stress this is not a South African phenomenon. This is a European and US phenomenon primarily. But the perception is that these two things equals very easy monetary policy, and interest rates are very low because of monetary policy. To some extent that's right, but for the wrong reasons. So what I'll do is first of all I'll try to talk about, give a graphical illustration of how I see US monetary policy since 2007-8, and how that has developed, and how we can explain what have happened empirically in a relatively simple but yet consistent with theory framework, graphical framework. Then I'll talk about a little bit about money supply and how we measure that, and how that has expanded or not expanded. I will talk about money demand, which you will see is key to this, and how money demand and changes in money demand has played a major role for monetary developments. And then, of course, what is the headline of this is that why are rates so low? But first I want to demonstrate that it's not monetary policy why rates are low, but you will see that very soon. Okay, if we want to think about monetary policy, this is how we do it. It's extremely simple. And that's, of course, the problem. It's so simple that even central bankers should be able to understand it. And students here. course, the best in South Africa. So, but we start out with what we call the Cambridge equation. The Cambridge equation is essentially just a money demand rule. You've all seen that before in some other form. It says that money demand is equal to K times P times Y. P is, of course, the price level. Y is the level of income. So P times Y is nominal income in the economy. And the K is what is called Marshall's K. If this looks like something you've seen before, but in another version, then it's because you've seen this. Everybody who has ever worked for me will know that I write this down several times a day. The equation of exchange. Of course, if you move this around, you would see that the K is just the inverse. The inverse of the velocity. So Marshall's K is the reverse of velocity. However, I think the Cambridge equations is easier for illustrative purposes. There is nothing theoretically different, but just in terms of what I want to illustrate, we use a Cambridge equation to illustrate money demand. We can also write that as in growth rates rather than in level, and that's the second equation. And then, of course, the Fisher equation, which all should be known. It says that interest rates, nominal interest rates, equals real interest rates plus inflation expectations. This, by the way, reveals something interesting. Just that simple thing is that if you have easy monetary policy, would you expect inflation expectations to be high or to be low? Easy monetary policy means that you would expect higher inflation. What would that mean for nominal interest rates? They would be higher. So as Milton Friedman, my all-time favorite economist, once said, interest rates are low when monetary policy has been tight rather than easy. How is that? Well, if monetary policy has been tight, inflation expectations have to be low, and therefore nominal interest rates will be low. That's not what we hear when we read the Financial Times or the Wall Street Journal. They go the other way around. But actually, starting from pure economic theory, this is the right way to do it. We can also put this graphically. Of course, there's one equation we didn't put in, and that's the money supply. So that's just vertical here, and take the money and inflation, and then we have the money demand function. And of course, there is, for a given money stock and a given money demand, we get a level of inflation. And that for a given real interest rate, we get a so you can see if we give shocks to supply or demand for money, then that would change inflation expectations and hence nominal interest rates. So that's our framework. So what happened in 2008? Well, this is the US. If you read the history of what happened in 2008, it's often described as a great financial crisis. Well, I would say it's part of the story was a financial crisis, but it was primarily a monetary crisis. And what we can see here is the dark green line is Marshall K. This is how the growth rate of, so to speak, the residual, more or less, in the money demand function moves. You can also say this is the shock to money demand. And you can see in 2008 there was a huge shock. The growth rate of Marshall's K went up dramatically. What happened? Well, in 2008 I was sitting on a trading floor in Copenhagen. And I was sitting in a bank that was about to blow up. Had I sat in any bank anywhere in Europe or the US in 2008, that was the feeling. It was, I tell you, not a very nice experience. It taught me a lot, but it was certainly not a nice experience sitting in a bank and it's on the brink of collapse. And why was Danske Bank, as I was working for, on the brink of collapse? Well, because Lehman Brothers had collapsed. And again, the traditional headlines would have been that, well, crazy animal spirit took over in the financial markets, everybody panicked, that was what was driving everything. Well, no, Lehman Brothers had played a very important role in the global financial system. Lehman Brothers was essentially an agent for the Federal Reserve. What the Lehman Brothers did was act as what is called a primary dealer. I think at that time there were 41 primary dealers. So imagine you are a European bank and you are invested in dollars and you have positions in dollars and you have funding in dollars. So you need to have somebody where you can, on a daily basis, interact to borrow dollars, because you have debt to service, which are in dollars. Lehman Brothers was providing that. Lehman Brothers essentially, and the institutional setup was such that the Federal Reserve was operating as a lender of last resort to the world through the primary dealer system. So imagine you're Danske Bank in Copenhagen, you need dollars. You would go to Lehman Brothers to borrow that, and Lehman Brothers would then borrow it from the Fed. When Lehman Brothers collapsed, the primary dealer system collapsed, and therefore the Fed technically ceased to be the lender of last resort in terms of dollar liquidity in the global markets. So they could provide dollars to an American bank, but since the entire global financial system to a very large extent is dollarized, it wasn't able to provide that directly initially. So therefore there was a scramble for dollars. Everybody just started to hoard dollars. They were afraid that they didn't have dollars. And rightly so. And that's what we see here. And of course the light green line here is that consequently the dollar strengthened very dramatically. So how would that look in our illustration here? So what happens here is essentially that we have a shock to money demand. The money demand curve shifts to the right. And for a given money stock, that causes we move from A to B. If we then roughly said what would happen to US inflation, it would be inflation expectations would move from 2 to 0.5%. I'll show that empirically in a second. So that's a huge deflationary shock as a consequence of this. Now, if you look at South African inflation, that kind of move is kind of common, that we move up and down 1 or 2%. But if all your contracts is based on that, it's not happening, and that you're based on your nominal contract is based on there always will be 2% inflation, and suddenly you expect 0.5% inflation, that's a massive shock to anybody having debt. So that's this would also be essentially push up real wages dramatically and cause unemployment to rise. So obviously that's not what we're looking at here, but that is the macroeconomic ramification of this. We could just expand this framework with a Phillips curve, short-term, a normal Phillips curve, then that we would have that shock. Dr. Holland and I have actually simulated that in a paper we wrote last year, that kind of shock. So what is the reaction of the Federal Reserve to this happening? Well, the Federal Reserve introduced what we call quantitative easing, essentially expanding the money base. So the Fed, as a reaction to the shock, with some time lag and imperfectly, increases the money base. This is what we call QE. We hear it all the time. They're doing QE, quantitative easing, an increase of the quantity of money. So that's what we do, and consequently we then move up to C. Now I write here that they didn't move it all back to 2, is that you will see that from the next graph, is that essentially the Fed never got inflation expectations back to where they were prior to 2008. If you look at the period from 2008 until today, more or less consistent, the inflation expectations measured from market inflation expectations from the bond market has on most time horizons been below 2%. So even though the Fed is targeting 2% for the past decade, it has more or less consistently undershot. So it's under-delivered, it has not over-delivered. And you can see that this is the, so the light green line here is inflation expectations. You see the drop from around 2 to around 0.5%, and then recovers as the Fed responds by moving into gear and starting to print money, so to speak. And you can see as well that the 10-year bond yield moves exactly as we said in the Fisher equation. As inflation expectations drop. Yields rise rather than drop. So the story we hear, that it's the Federal Reserve and the ECB and other central banks that have pushed down bond yields, seems somewhat odd. At least if we just look at the episode, it's the opposite is happening. Once the Federal Reserve move credibly to ease monetary policy, push up inflation expectations, the bond market reacts by pricing in higher inflation, and therefore bond yields goes up. So that's what we see here. You will always also see, and I'll return to that, that it has been trending down. This is until 2011. If we extend the graph, it has trended down even further, and then recently rebounded. But there has been a long-term trend in bond yields that I will try to explain later on, but for now we just look at this. So this is the Fed's response. This is just looking at the money base. How much money is the Fed printing? And you can see in 2008 we have this spike and then gradually upwards. So this is the initial reaction. However, this story is not entirely right, because at this time Ben Bernanke was Federal Reserve Chairman. Ben Bernanke, of course, is a monetary historian among other things, and he knew very well about the Great Depression of the 1930s. Written extensively about it, and Bernanke's view of the world is that 1930s crisis was caused by a banking crisis, and therefore if you want to avoid repeating the depression, we wanted to avoid the banking sector collapsing, and therefore he focused his attention on the banking side. You can say that he was focused on credit rather than money, which is not the same. So he was focusing on that. So he knew he had to print money, but he didn't print money to get inflation expectations up. He essentially printed money to save banks. And consequently, he wasn't too happy actually to see the money getting into circulation. So he said, what can we do to give the banks some money but make sure that they don't become inflationary, which is kind of the opposite of a monetarist perspective out of this mind, where you would say, yeah, we want to create inflation, or you want to avoid the deflation when you have a negative shock. Well, he said one thing. He said, we would like to see banks bring back the money to us. So what the Fed started to do already in 2008, when they did quantitative easing, they also said we will pay interest rates on what we call excess reserves. So in the US, it's mandatory for banks to hold a certain level of reserves, so-called reserve requirement. I think the same is the case in South Africa. It's not in many European countries where this is regulated in different ways, but in the US you have a mandatory reserve requirements. But the Fed then said, if you bring more reserve than what is mandatory, we will pay interest rates on that. And in fact, we will pay higher interest rates than is the market rate. So why did they do that? Well, they did that to separate the two things. They wanted to control interest rates and the money supply in two different ways. You all know about the Tinbergen rule, which essentially says that, you have a hammer and a nail. And you can only put up a picture with the hammer and the nail, but you cannot at the same time make a hole in your son's head. And you shouldn't. So this is the same thing here. He wanted essentially to introduce one more tool. And he did that by introducing the interest rates on reserves. Consequently, what we saw was a quite significant increase in reserves. Commercial banks essentially lending money from the Federal Reserve and putting it back into reserves. Very nice scheme, because that is what we call a carry trade. You're borrowing at a low rate and putting into something giving a higher rate. This is kind of scheme that the most naive investors are doing. By the way, there's empirical evidence that carry trades actually can be quite useful, but that's another story. We'll leave that for finance class. They're doing carry trades, and in that way essentially recapitalizing the American banking sector. That served the purpose. But it didn't serve another purpose. It didn't really expand the money base, because you can see here the light green line is the increase in excess reserves. So printing money, taking it in again. That's the excess reserve story here at play. So, to get a real idea about how much money did they really print, we can look at the difference between these two. This is what the American economics professor Jeffrey Homelock called outside base. He essentially take the money base and deduct excess reserves from that. It would be the inflationary part of the reserves. And the dark green line is the outside base in levels, and you can see the slope increases after 2008. So clearly we have an acceleration in money-based growth. But you also have to remember we have had an increase in money demand. And how inflationary monetary policy depends not only on the supply of money, but also on the demand for money. So it's between the two we get a determination of the nominal income level and inflation. So, but it isn't that kind of massive helicopter drop of money all over the world that we would think of if we read the popular media, or the serious media as well. If you look at it, this is growth rate, the light green bars are growth rates at the outside base, and you can see it surely increases, but the growth rate is 4, 5, 6% after 2008. Hardly something that one should expect to be hugely inflationary, and it hasn't been. Another way of looking at that is looking at another measure of money, looking at what we call division M4. Division money supply numbers take into account you have different level of moneyness, so to speak, in different elements of your money supply. The cash you have in your pocket is very liquid. You can use it immediately. So is the deposit in your bank. But it might be that you have a money market paper where there's some transaction fund cost and so forth. So you can correct for that. That's the division money concept. It's a perfect topic for a master's thesis, just an idea. And looking at the growth rate of that. And you can see that in the US, prior to the crisis, the growth rate of M4 division money was around 6%. You then see a significant contraction in money supply. And this is where Milton Friedman, if he had been alive, he died in 2006. He would have said there was a massive monetary contraction in the US which causes crisis, and it's very similar to what happened during the Great Depression. The Fed reacted to that, but you can see division money growth has been around 4%, so significantly lower. So just looking at that graph wouldn't be surprising that inflation has been lower after 2008 than prior to, because the money supply has simply grown at a slower rate. If you look at Europe, the story is essentially the same. We see prior to 2008, M3 growth in the Eurozone was 6.5%. It's a somewhat miraculous graph, this, because it shows M3 growth going back to the mid-90s when there was no euro. This is, of course, so combined, but from 2000 onwards, the average growth rate of the money supply until 2008 was 6.5%. And you can see that the ECB has not been doing a lot of money printing. In fact, until 2015, money supply growth in Europe was extremely low. Again, therefore it's hardly a surprise that we in Europe have been struggling with deflationary pressures rather than inflationary pressures. And again, this is completely textbook monetary theory. Really, there shouldn't be any central bankers around the world being surprised that we don't have any inflation when money supply is growing at a slower pace than money demand. So, what is happening to money demand? Well, there are some long-term trends. What I've done here is to look at the US, and again we go back to the Marshall's K. What is the trend growth of Marshall's K? We could do that with much more fancy econometrical methods, but we could also just look at average. What we've done here is look at the growth rate of Marshall's K. We use based on M2 numbers. We could have used other money supply measures, doesn't really matter. You can see the shock we saw before in 2008, but look at the trend growth rate of money demand. It is significantly higher than before. So for a given growth rate of the money supply, we now have higher money demand. What would that imply for inflation? It should be lower. And that's rather consistently what we have. So again, essentially, if you were a central bank and observing that the trend growth of money demand is going up, what should you do? To hit your inflation target, you should have a higher growth rate of the money supply than otherwise would be the case. Of course, we never really talked about that. When we talk about the story of monetary policy and the reaction to the crisis, it's rarely mentioned that what have happened to money demand. And money demand has shifted up both in US and in Europe. And there are a number of reasons for that. I will go through that rather fast. First of all, something that I think is extremely important for this is an aging population. The fact is that if we look at Europe and the US, the life expectancy has gone up rather significantly in the past 20 years. There is aging of the populations. So take the US, for example. We had the baby boomers born just after the Second World War. If you're born in 1945 at the end of the Second World War, if you're an average American, you will retire 63 years later. That is, surprisingly enough, 2008. So the baby boomer would retire exactly as crisis hit. And there might be some relationship between that. What happens with your cash holdings? Well, if you're a student at Stellenbosch, you spend the money faster than you make them. If you're a middle-aged professor, you're thinking about, well, at some point I will retire. I better put away some of that. If you are 30 and working in the banking sector, you put away some of that, but you put it into stocks because you take risks. You're not going to retire now. But when you're soon 50, as I will be in a couple of years, you begin to think, at some point I need to retire. If you are 60, you will say, well, I should put some of this money into something safe. I don't want to take too much risk. So you change your investment pattern as you age. And what you would do is you would demand more safe assets. Among that, more cash. So as you have an aging population, it's likely that your demand for cash will go up. We will demand more cash, and money demand function, the velocity of money will be changing, and the same with Marshall's K. So I'll show that later. The other thing is that the international demand for dollar has gone up because a lot of banks got caught without dollar access in 2008, so they better start to hoard some more dollars if this was going to happen again. Central governments around the world are holding more cash than ever. We hear about a lot of stories about very irresponsible governments, and that's not only in South Africa, that's all over the world. But the fact is, if you look at European governments, for example, they're holding a lot more cash than before. And actually US cash holding by the US Treasury has been going up, even though their budget deficit is going up as well. And then we have, I think, very important change, financial regulations. Policymakers around the world have said, never again. We don't want banks to blow up again. So how do we make sure that banks don't blow up? Well, we make them more boring. We force them to be less leveraged. We force them to hold more cash. This is called liquidity coverage ratio. This is all part of financial regulation both in the US and Europe. So you're forcing everybody to hold more cash. All of these things are drivers of why money demand is higher than before 2008. Not spending too much time on it, just an illustration here of a phenomenon where we can go way back. The gray line here is what we call the population ratio. This is the part of the population which is in the prime age, which are working class age. So it's from, let's say, 20 to 65, or 60. So as the trend declines, it means that we are getting older. There are less people in the labor force relative to people who are older. It could also be because we got more kids, but that's not happening in Japan. So here's an illustration of the aging of population. And the other line, the green line, is the money velocity in Japan. So remember, the Marshall's K was the inverse of the money velocity. You can see there's a fairly good long-term relationship between this. Dr. Holland and I have done a little bit of work on the empirical part of this for other nations, and it seems to be that there is a relatively close relationship with long-term trends in money velocity and the aging of the population. And so even without a crisis, the fact that the Europeans and Americans are getting older would tend to be deflationary. And Milton Friedman would have, of course, have said, inflation is always and everywhere a monetary phenomenon. You can just print some more money, then it's not deflationary. And that's correct. But there are two sides to this. There's the money demand side and the money supply side. And the money demand side of this is deflationary if we don't print more money. So even had there not been any crisis, it's likely that we would have had to move closer to quantitative easing. So that brings us to the main topic. So why are rates so low? If it's not because of monetary policy, why is it? Well, if we look at the long-term trend in U.S. bond yields, it has been declining over time, and we see the same in Europe. By the way, see the same in South Africa, but the pattern is very clear in the U.S. that since the early 80s, when bond yields peaked, we have seen a rather constant downward trend in nominal interest rates on all time horizons, all maturities. Originally, we didn't see a downward trend in real rates. Most of the drop in yields was just because inflation expectations were coming down. You can see that the gray line here is real rates. So this difference between inflation and nominal bond yield. But since around 2000, real rates have been coming down as well. So that's the interesting thing. And you can see that downward trend in real rates started way before the crisis. The pattern in Europe is exactly the same. And in South Africa as well, by the way. So we have that downward trend in both nominal and real rates, particularly since 2000. So what we did was we said, okay, can we measure this? Can we make an econometrical model to explain why this is happening? And we said, yeah, we always identified that demographics plays a role. And the Fisher equation tells us that inflation expectations plays a role. So we need to bring that in. So we look at the number of people between 65 and 75 or 74 years old across countries. We look at 20 plus countries. We also look at financial regulation. What countries have implemented the so-called Basel III, have tightened financial regulation. In our models, that is just a dummy. and I'm rather unsatisfied with how that we're measuring this in this way, but that is a very crude way, but it seems to work at least. And then we look at an unemployment gap, which is not really important. It can explain some of the moves. The unemployment gap means the difference between NIRO, the natural level of unemployment, and the actual level of unemployment. That can be different from country to country. So that it's kind of a measure of the business cycle. It has essentially very small impact in our 10-year model, but just to get that into the model as well. So what is the result of that? Well, what we've done is that we then try to break down the movement in exchange rates across countries. That wasn't very nice. South Africa is not there. You haven't disappeared. You are on the next slide. But this is focused on the countries where we have seen rather large changes in monetary policy. So can we explain what is happening? Take, for example, the US. So the green bar is the explained change in US monetary or US 10-year yields based on a model where we put in these different variables. So that's a panel estimation. And you can see that US interest rates were supposed to drop around 300 basis points. 300 means 3 percentage points from 2007 to 2017. Why did it happen? And you can see the cross there is the actual change in bond yields. It's been a little bit smaller than how much it actually should have been. What is driving that? Well, you can see that the Basel III is about half of that change. That's in the US includes the Dodd-Frank financial regulation. But then we also have a fact that US inflation is lower than prior to the crisis, which pushes yields down a little bit. And then you have the demographics, probably around 100 basis points. If we go even further back to 2000, the impact is even bigger. So another way to illustrate this is the model prediction for where interest rates ought to be given what the model is saying and where they actually are. This is by the end of 2017. And you can see that the countries line up perfectly nice and the model fits pretty well. Had this been a purely academic presentation, there would be somebody saying, I really don't trust this guy's econometrics. Well, I'm a private sector guy. I need to deliver results. You got results here. You can, by the way, see South African yields are exactly where they ought to be. If you zoom in a little bit more and you were a trader, there was ample room for moving in all kinds of directions. But overall, the picture is so that we can explain both the level and the change in bond yields fairly well based on these factors. And financial regulation and demographics seem to have a lot bigger impact than any impact from monetary policy. In fact, if anything, monetary policy has contributed to lowering yields because inflation expectations have been too low. Monetary policy has been too tight. So again, the entire story that this crisis, or what we've seen since 2010 in terms of yields, has been driven by excessively easy monetary policy is wrong. We cannot show that. Rather, we can show that these are structural factors at play. Another way to look at this is looking ahead and say, okay, demographics. We know demographics. You know, I've been doing economic and financial forecasting for 25 years. And I'll tell you, it's for those of you who will attend tomorrow, I'll talk more about that. But it's a pretty hard task on a 3-month horizon, saying, okay, where will the South African rand be in 3 months? Well, it's impossible to say. I would much rather say how large will the South African population be in 10 years? Because most of the people around in 10 years have already been born. And we know how many die every year. So that's much easier to do long-term demographic forecasting than short-term financial forecasting. So what we do here is we look at the demographics, aging populations around the world. What will, given our model, how will that impact 10-year bond yields? You know, it will over the next decade lower 10-year bond yields in countries like Singapore and South Korea by nearly 2 percentage points. And given the fact that these countries already have interest rates very close to zero, means that forget about interest rate hikes. We are essentially in a situation where interest rates, or what we call the natural interest rates, will remain fairly close to zero around the world. It will move up and down with the business cycle and maybe with inflation expectations to some extent. But for most countries, the drag from demographics will be negative. So low yields is, as Bill Gross, who used to be co-founder and owner of the largest bond fund in the world, PIMCO, used to say, it's the new normal. It's a permanent thing, or long-term thing, that rates and yields are lower in the developed part of the world. Obviously, in other parts of the world, that don't have to be the case. You know, you can have Zimbabwean-style monetary policy of 2008, and your bond yields are likely to shoot up rather dramatically. You know, we could install Gideon Gono, who used to be Reserve Bank governor in Zimbabwe, as Reserve Bank governor in South Africa, and you would very soon then see very high yields. But of course, that's not what we're talking about here. The underlying natural rate is driven by, to a very large extent, demographics, and across the world, that's negative. And you can see in South Africa is relatively small, but negative, 30, 40 basis points down. I'm not saying that that is what actually will happen with South African yields, but the impact from demographics is negative. You can see there are actually only 3 countries where this has the opposite effect. And interestingly, when we talk about demographics, is Japan. And Japan is aging, but those who are old in Japan are now very old. So they're dis-saving, they're not hoarding, they're dis-saving because they don't have any more money, so they're dis-saving. So they're not in this particular age group we're talking about. And there are actually also other positive demographic factors at play in Japan, particularly women entering or re-entering the labor force. And then Sweden, immigration debate in Europe. Sweden have taken a very significant amount of Syrian refugees after the Syrian civil war started. And that is having a very positive effect on Swedish demographics. So to the extent that the Riksbank, the Swedish central bank, was struggling with a zero lower bound problem, so to speak, that interest rates were at zero, immigration is helping that problem. Maybe other nations could learn from that. So that's one way of saying it. An alternative model is just looking at one country, but essentially looking at some of the same graphs. So what we've done here is we looked at 10-year yields in the US, and we explained that from 4, or rather 5. One is, of course, inflation expectations, but the 4 others is population growth, so that's the demographic variable. The other thing is potential real GDP growth. Why is that interesting? Because potential real GDP growth have declined very significantly in the past 15 years, both in the US and in Europe. So productivity growth is lower. So if you have been following your lectures in growth theory, you would remember from the Solos growth model that G equals R, if I'm correct, that essentially real interest rates have to reflect the long-term growth rate of the economy. That model can be refined in all kinds of fashions, but in most models of growth, we have a relationship between lower potential growth rates and lower real rates. And then we look at the real effective exchange rate. And then consumer confidence, we could have used other measures of the business cycle, but that is essentially just to capture. And this shows I was once a banker. It's all in tiny letters, so you can't see anything. You just find it, you know. This is a very simple regression over time. Again, the econometricians would say, you did something wrong here. We probably did. I need results. the important thing is that all our coefficients are very significant, all of the variables. Population growth indeed, lower population growth indeed do lead to lower interest rates. Lower potential growth, productivity growth lowers real interest rates. A stronger currency causes yields to drop. And a higher consumer confidence, meaning a stronger economy, pushes up rates. This is capturing the business cycle element. Overall, it's the first two factors that are really important in the estimation. So this is the output. What you would see is that if we look at the predicted real yields and actual real yields right now, the number is more or less that yields and rates are exactly where they ought to be. Why is this important? Well, it's important when I talk to a client. If I talk to a Scandinavian pension fund or a London-based hedge fund about where do I think bond yields will be next year, well, or in 5 years, I have some input to use that. This is applied economic theory. Interesting thing is, of course, we know there are forecasts for potential growth in the US done by the Congressional Budget Office. We know the demographics. In terms of the business cycle, we know that in the long run, the output gap would be closed. So we just take that out. So essentially using potential GDP growth and demographics, we can do a forecast for how should US real yields develop in the coming years. And they should, according to the model, increase slightly. But the underlying thing is here that we are not going to see real interest rates going back to levels that we saw, for example, in the 90s. And that's important for the story, is that the reason that rates and yields are low, when we look across countries and look at the US over time, the conclusion is the same. Productivity, financial regulation, negative demographics, all contribute structurally to lower real yields. And for a given inflation target, therefore nominal interest rates should be has declined as well. And there's no reason to believe that you're suddenly going to see rates and yields spike dramatically. Of course, if you apply that to South Africa, the story much more becomes a question about inflation expectations. If we go back in time, the Reserve Bank, as you know, the Reserve Bank targets inflation between 3 and 6%. I never really understood why there ought to be a 3% band. Why don't they just say 3% or 4%, plus minus 1? You should be able to do better than that. They are in full control of the printing press in Pretoria. There is no reason to have an outcome like that. Anyway, because of that, you have much more uncertainty about inflation expectations. You could suddenly get an Gideon Gono type Reserve Bank governor. Hope not. But that risk is there. All of that kind of risk would be, of course, reflected in inflation expectations and hence in South African bond yields. But the underlying story about real bond yields in South Africa is essentially the same because negative demographics also play a role here. So there is no reason to see real rates in South Africa ought to go up significantly higher. I should say for emerging market countries like South Africa, the credit risk, if you look at the front page of today's newspapers in South Africa, there would be a story about the rating agencies Moody and say, what will Moody's say? Will they downgrade South Africa or not, as Fitch and S&P have done? The Treasury is now telling us that will certainly not happen. So we hope so, but of course that is a measure of the credit risk, and that kind of credit risk should be reflected in real rates. So we're not measuring that directly here because that is assumed to be stable over time, but that necessarily is not the case for a country like South Africa. But the overall trend is as I said. Good. Let me just, to conclude, have a short look at where South African monetary policy is right now, just to warm you up for the coming days. What we do at Markets and Money Advisory is to Every quarter we publish a publication called Global Monetary Conditions Monitor, in which we look at monetary policy in 26 countries across the world, including South Africa. And the idea here is essentially what I've been talking about over the past 45 minutes, is the right way to measure monetary conditions is to look at the supply of money relative to the demand for money. And we then essentially look at the different parts of the Cambridge equation. We look at nominal demand, so that's the P times the Y. So we can say, how fast should nominal demand be to deliver 2% inflation? That's what we call the policy consistent growth rate. We look at the money supply, given the development in Marshall's K and the underlying trends in money demand, how fast should the supply of money be? And essentially do similar things on exchange rates and interest rates, and then get a composite indicator of monetary conditions based on that. And that's what we have here. That's a South African indicator. It's constructed in such a way, if the indicator is 0, the Reserve Bank will deliver on its inflation target, or should be expected to deliver on its inflation target 2-3 years ahead. You can see in 2006, 7, and 8, the Reserve Bank was not exactly conducting monetary policy in such a way that it would deliver 4.5% inflation down the road. And in fact, it has just recently come into that below that overshooting scenario. We are still more likely to overshoot than to undershoot the target. So you can say that the Reserve Bank had a different problem than the ECB and the Fed. The Reserve Bank had too easy monetary conditions to deliver on its inflation target. And you all know that they have been consistently in the past 20 years overshooting rather than undershooting its target. But at the moment, we are pretty close. And that means that if we convert this into inflation forecast, I don't want to spend too much time telling why we're doing that, we will see that we will have inflation in 2-3 years somewhere between 4.5% and 5%. That's not too bad. That's pretty close to bullseye in terms of the target. One can discuss why South Africa need to have 4.5% inflation rather than 3%. I don't see any reason why it shouldn't be 3%, but that's another discussion. The target is stated, and at the moment, it's very hard to be very critical about the conduct of monetary policy, or the calibration, I would say. So I think that concludes it. I know that some of you are going for lectures at 1 o'clock, so if you want to run out for that, I will not be angry. But I thought we might have 1 or 2 questions, and I'm staying around afterwards as well. So yeah. Yeah.
Just so in terms of your equations, did you try fiscal deficits in there as well, or are you saying that the inflation expectations will pick up whatever is expected on local deficits? Because especially in a country like South Africa,
Yeah.
I mean that is another.
Yes. So the question is essentially, what role would fiscal deficit play for real interest rates? And obviously there are two. You essentially have two kind of effects where this is important, both on real and on nominal interest rates. First of all, if we have a larger government deficits, we have less savings in the economy, and consequently that should tend to push up interest rates, real interest rates. And the other factor is that you get into unpleasant monetary arithmetic kind of view, that if you have a large current account deficit, the risk that you would turn your monetary policy into kind of Venezuela, Zimbabwe kind of, I would just call the central bank and ask them to print some money for the treasury monetary policy. That's another risk. That would increase inflation expectation. That's what we call the unpleasant monetary barometrics. We did not test that in any good fashion. We played around with it a little bit, and we can't get any real consistent results. I fully agree that you cannot ignore these impacts on a country like South Africa, but for most of these countries in our estimations have had fairly stable public finances. They have not been Obviously, they all have increased public debt after 2008, but that would really have contributed to increasing real rates, and we haven't seen that. So, and we can't capture that. We can't capture any of that. One then could say that maybe we should take into account the change in fiscal policy, so the demand impact, so fiscal impulse kind of measure, and that we haven't looked at, but I think there would be scope for looking into that in terms of the monetary policy response to fiscal changes. I've done other work where that's very clear that there is a strong relationship between the performance of the economy and how fiscal and monetary policy plays together. But I think what we would need to do is to look at episodes where fiscal policy become unsustainable in a really critical fashion. So in a European sense, late 70s, early 80s in a number of countries, my own native Denmark saw real rates skyrocket because of unsustainable fiscal policy in the early 80s. We saw it in Ireland later in the mid 80s, and these are cases where we talk about the tightening of fiscal policy, then pushing down real rates. So we can clearly find a historical example where it's important, but across country in this time period, we were not able to get just simple measures of this. I think if I want to venture into this more, I would take a number of countries with less weaker institutions, where it's more likely that you will have monetization of public debt, and where it's more likely that you won't care for creditors. Yeah, and then I think there is non-linearities in play here, that if you get to a certain level, everything explodes. But if you keep it contained, nothing happens. And we can see it in the US. US debt levels have increased very dramatically. Nothing will happen. Japan, of course, is the most prominent example of debt close to 300% of GDP, public debt, and interest rates at zero. Yeah. I don't say that fiscal policy is not important. I'm nearly saying it. But yeah. More questions? Maybe you have a question.
Oh, okay.
Yeah.
Well, I mean, this actually extends to that. If it is the government doing most of the spending, and there's not spending on high enhancing stuff, then the will stay low because of that.
Yeah. So yeah. No. That. Yes. When I become yes. Take the case of South Africa. South Africa has extremely high level of public expenditures directly to salaries in the public sector relative to GDP and relative to the size of public spending. Most of it just simply goes to pay salaries in the public sector. And one can discuss how much of that is productive. It's certainly not as productive as in the private sector. So the more you spend in the public sector, you take away productivity from the private sector. And that's a very clear relationship. Doesn't mean that the public sector cannot produce something which is of enhancing productivity, education, for example, building roads and stuff like that. I just talked to Dr. Hollander before, and I said, when I used to be in government, I was a speechwriter for the Minister of Economics between 1995 and 2000 in Denmark, and we used to joke that her policy department, the discussion among the economists was whether the size of the government should be 0% of GDP or 5% of GDP. So you didn't ask the right guy the question here. But I do think a too large public sector has a tendency to lower productivity growth, and that would cause real yields to be lower in that sense. Yeah. Not necessarily nominal rates.
Thanks, Lars.
Thank you very much.